Hi, welcome to T-Minus Retirement. We have a cooling labor market and a bull steepener rocking the market. Stay tuned to find out what it means. Hello, everybody. Dustin here with T-Minus Retirement, the podcast where we help launch your retirement into orbit. As I mentioned in the intro to this video, we have fresh new labor data. It's Friday, the 5th of September, and this was a highly watched labor report, and it gave us some clues as to what's taking place under the hood with the labor market cooling a little bit. And funny enough, that's exactly what the stock market wants long term, because that is going to signal to the Fed that they can start to cut rates here at the September meeting. So it's a little bit counterintuitive for you to, or for the market to want the labor market to cool. But I think it's good to put that into a little bit of context, and that's what we'll do today. Again, so labor market cooling, but what does that really mean, and what levels are we looking at coming down from, or coming up from, I should say. So we can take a peek here, and I pulled up some data from the U.S. Bureau of Labor Statistics. Really exciting website, but they do show the current data that came out today. And what it looks like is we have August data employment numbers, and the total unemployment ticked up to 4.3%. I think a couple things to really keep in mind is we're coming off of a super low base. This is after COVID, obviously, when we had unemployment spike because we were all forced to not go to work. So we were at a 3.4% unemployment rate, which historically super low. I mean, this goes back to August of 2005. Obviously, financial crisis here peaked at 10%. Took a decade to come back down. We were at 3.6% right before COVID, and then COVID happened. It spiked and it's come down. We've had a labor shortage right after COVID, and we've been creeping back up. I don't think that this cooling labor data that we got today, it sent a lot of headlines around the news. I don't think that that is something to be overly concerned about. It's certainly not spiking. I feel like it's getting back to a more normal long-term average. The long-term average for unemployment over the last 30 years was 5.67%. So we're still well below the long-term average for unemployment. But what that does, and we've talked about this in the last video on T-Minus Retirement, what that does do is that's the second component that the Fed is looking for to give them the signal that they can lower rates. The first signal is inflation. We talked about inflation in our last video, but to just recap, I believe that the Fed is looking at quite a bit of lag data when they're determining, what the true inflation number is. I think it's a little bit lower than they're estimating. They've held rates fairly high now for 3 years, really kind of sticking to their guns of trying to squash inflation. I believe that has been successful, and this is the second component now that can show the Fed that they need to lower rates, and I believe that they do need to lower rates. They're probably about a full percentage point too tight right now, but ultimately this, I think, will be the second component that will allow the Fed to have some data that they can stand on and it not be, perceived in a political way. But let's be honest, no matter what, it's going to be perceived as some type of political move. But ultimately, I think they will cut rates here. It's looking like at least a 0.25%, 25 basis points. I think the market would be surprised if it was more. I don't know that that's really what we want, but I think that it is very healthy and constructive for the market to start to see that, hey, we've got rates coming down. We have easy policy, at least, starting, at least a little bit of easing, and the economy's still in good shape. Obviously, we've talked about earnings on the podcast. They've been holding up very well. Inflation has come way down from the peaks after COVID. And, if you use real-time data, I think is a lot lower than what even the Fed is looking at by some of these older methods that they collect data. And then this is the last component. So we'll see what they do, what the Fed does here in September, but I think that's going to lead to lower rates. Now, what does that mean for the equity market and the bond market? I mentioned that we have a bull steepener. That's kind of a interesting term that they're putting out there in the news. And what that means is basically we have short-term fixed income rates falling faster than long-term fixed income. And I've got the yield curve up here basically to demonstrate that. So we have short-term rates on this side. We have 5, 7, 10-year, 20, 30-year treasury over here on the right. And what you can see is short-term rates at 4.33% as of yesterday on this 1-month treasury. They're higher than even a 2, 5, 7, 10-year. You only start to get above that on the 20 and 30-year. But what we want to see is this part of the curve start to come down. And also this part of the curve in this bull steepening type of example is the 10, 20, 30 year will also come down, but they should come down slower than the short end. And the reason for that is the Fed is going to reduce Fed funds rate. That is going to have a very quick effect on short-term rates because those fixed income products are going to renew very quickly and they're going to be set at the newer rates. So this should come down fairly quick. I think what that is going to cause is and we mentioned this in other videos too. I think what that's going to cause is all the money that has been on the sidelines, that's been getting 4, 5% with no risk, soon that is going to start to cause people to think of twice about, hey, should I have all this money in this money market account in this CD? Where can I deploy that to get a better rate of return? Because as the Fed funds rate adjusts down, short-term interest rates are going to come down. CD rates have already come down. Money market rates will come down fairly quick as well. So that's going to cause people, it's not going to be immediately, but it's going to cause people to say, okay, I've got all this cash. I need to deploy that somewhere. And not all of that will go to the equity market. Some of it will. Some of it will go to maybe some other fixed income products that will retain the higher yield for longer. But ultimately, I think it is healthy that we have more money coming out of these really safe havens and put to maybe some better work long term. Ultimately, too, there's an article here from Charles Schwab, and they mention essentially that the bull steepening, if I can find it, the bull steepener dynamic where short rates fall faster than long rates is a constructive move for equities and the broader economy because it often accompanies improving growth expectations and a soft landing setup where policy shifts from restrictive towards merely neutral without reigniting inflation. That's probably that last little component is a big key. We can't and we don't want to see inflation start to tick back up. All signs have been that hasn't happened. Certainly we have a couple tailwinds. I mean, oil's way down, from some of those highs, so that will help keep that inflation down. But all that is to say, a lot of the data that came out today, I think, is pointing to further evidence that the Fed will cut here in September. The ramifications for that, lower yields on these ultra short fixed income products, whether it be money market, high yield savings, CDs, floating rate treasuries, those types of things. But that in conjunction with a strong economy, we still have the labor market hasn't imploded. It's still 4.3% unemployment. I think that's a great, still a great place to be. We have earnings coming in fantastic. Markets have been pricing this in, and that's why markets are at all-time high. Now, before we go, September tends to be a choppy month for the market. August and September tend to be choppy months for the market. August was a pretty good month for equity markets. We're in the first week of September. People get back to work. They reallocate, they reposition. So if we see some choppiness in September, I don't think that that's out of the ordinary. And that will really set us up for the fourth quarter, given all the backdrops that we've talked about, to hopefully have a good finish to the year. So that's my 2 cents at least. I hope that you enjoyed the content in the video today. If you did, please like, subscribe, and I look forward to seeing you in the next video. Take care.